Well, good afternoon. Happy Friday, August the 5th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Boy, a lot of confusion, and there's no mystery why there's a lot of confusion around where mortgage rates currently sit. So we've had a lot of events, very public events over the past couple of weeks that would make you think interest rates are headed one direction or another. And because of these sort of publicly reported events, sometimes folks think the market's in one place when it's actually in another. A good example of that is what happened when the Fed raised the Fed funds rate this past month. When the Fed raised the Fed funds rate in July, everybody thought interest rates are headed up. The Fed just raised rates, quote unquote rates, by 3/4 of a percentage point. Did interest rates go up by 3/4 of a percentage point? No, they did not. They actually went down on the day that the Fed raised the Fed funds rate. And going into the end of last week, we really saw interest rates at some of the best levels that we've seen since early spring. Interest rates headed down towards the mid-4s as of the end of last week. What was behind that? Well, essentially, it's prevailing sentiment that inflation may just be under control and that the long-term outlook for interest rates is towards a lower figure. We're thinking that maybe sometime in 2023, the Fed might actually be cutting interest rates. We see this with the 10-year and the 2-year treasuries. The 10-year treasury is actually lower than the 2-year treasury. That's called an inverted yield curve. It's one of the signs, one of the signals of a pending recession, an inverted yield curve, where a 2-year instrument, a shorter term instrument, would actually pay you a higher yield than a longer term instrument like a 10-year. So, kind of contrary to what you might think, you hear the Fed's raising interest rates, but interest rates actually went down last week. The opposite is sort of what's happened this week. The opposite now, we're getting all the headlines, finally, that the news media is sort of catching up with how dynamic the mortgage market's been, and everyone's reporting, hey, interest rates have dropped. Well, this week we got some not so great news, especially today, and that's what I want to drive down or drill down on here. Let me flip the screen around, show you where mortgage-backed securities are. This is the financial instrument upon which mortgage interest rates are based. You can see mortgage-backed securities down on the day by about 33 bips. That is driving interest rates up. Whenever mortgage-backed securities sell off, interest rates go higher. You see, we didn't have a particularly good day on Tuesday, and we're not having a particularly good day today. Why is that happening today? Well, you need to only look as far as the non-farm payrolls report. This is the amount of jobs that were added over the past 30 days. And you can see we thought we were going to add about 250,000 jobs. We added 528,000 jobs, more than double what the consensus was. That just means we still have a white-hot labor market. Unemployment actually went down. This is one of the vexing things for economists as to trying to determine whether in a recession or not in a recession. We see GDP declining, we see the inverted yield curve, but then we have an incredibly strong labor market with very low unemployment. That doesn't fit the narrative of a recession. Typically in a recession, you're shedding jobs, unemployment's going up. We're sort of doing the opposite here with this. And that's not terribly good news for bonds because the market doesn't know what to make of it. And if inflation is still a problem, we're going to get an indicator of that next week. If inflation is still a problem, boy, a 3/4 point Fed funds rate hike is definitely still on the table come September. So that's something that we want to keep our eye on. Almost everyone thought the Fed's going to be tapering back, maybe just a 1/2 point hike in September. But now futures traders are thinking there's a really good chance that the Fed is going to have to hike one more time at 3/4 of a point. We'll see how that plays out. One other thing that makes trying to figure out where interest rates are confusing is this right here. This is the Freddie Mac weekly survey, and the key word in that sentence is weekly. Freddie Mac comes out and they post a weekly survey at the end of each week. They take their indications every Thursday. So on Thursday, they take the indication and they say, here's where rates are. Well, the problem with that, when you take an indication on August the 4th, is that you're reporting to everyone as they're going into the weekend without taking into account what happened on August the 5th. And August the 5th, mortgage-backed securities sold off and interest rates were headed higher. So this information posted on August the 4th here on Freddie Mac's website is already obsolete because of what's happened in the last 24 business hours. Of course, a lot of dynamic movement around the mortgage-backed securities market. That is not going to change as we move into fall, out of late summer and into fall. Keep it tuned right here. Let me know if you have any questions for you going into the weekend. Mark.Milam at highlandmtg.com. Thanks.